Welcome to video T12C. I guess we just pinged for a couple pass-through videos. Now let's pong back to a corporation and talk about some strategies to mitigate the effects of double taxation. One way to avoid double taxation with a corporation is to create a deductible payment to the owner. Recall that dividends, although taxed at a lower rate by the shareholder, are not deductible. Certain deductible payments can be structured as corporate deductions, however, and that list includes interest, rent, and wages. Let's use interest as our example. Obviously, to generate interest, the shareholder is going to have to loan the corporation funds, and the debt will need to be bona fide. In situations where there is a single shareholder, it's particularly tricky to ensure that the investment is respected as debt and not equity. As with a single shareholder totally in control, it's hard to argue for anything but equity. However, steps to contribute to debt classification include ensuring that the form follows that of debt, with a note and a reasonable stated interest rate, and of course that the interest is actually paid. Any breakdown in the form of debt is likely to destroy any chance of interest expense being respected. That said, in this example, we have another 4-column presentation. I must love 4 columns. Column 1 is 2017 rates without a deduction. We saw this example in a past video, and you can see that the $400,000 turns into about $224,000 after taxes. Column 2 is the same, but it has a $100,000 interest deduction. Consistent with some of the prior presentations, I have assumed a 28% individual rate on ordinary income that results from the interest income going to the shareholder. The result with the deduction is better to the tune of about $16,000. This is the shift of $100,000 of income from corporation to individual, netting about a 16% tax savings. In column 3, we reperform the same analysis, but now at the new 21% corporate rates. Obviously, even with non-deduction and double tax, we do better at 21% than at 34%, as expected. However, note how that in column 4, when we introduce the deduction, the savings over non-deduction at 21% is now only about $5,000. You can see how the lower tax rates diminish, but don't completely eliminate the effect of an income shifting strategy. A couple of important notes. Interest and rental income, which would be obtained if the individual owning the business property rented it to their own corporation, are both ordinary income. And so taxpayers with ordinary income rates higher than our assumed 28% are going to see diminished returns to this strategy. Also, if a wage strategy is utilized, the taxpayer needs to be aware that employment taxes are also likely to decrease or even eliminate any tax savings from shifting. This strategy will be more efficient if the taxpayer is already above the FICA cap with earnings, so that the employment taxes are reduced to 2.9%, or maybe 3.8% with the additional Medicare tax. On the flip side, a taxpayer with low income might enjoy a 0% dividend rate and might prefer the double tax, since in actuality, the second tax is at 0%. Of course, not many individuals in the income shifting environment find themselves in the 0% tax rate. Because of the temptation to shift income from a corporation to a shareholder, taxpayers have taken aggressive positions by paying themselves excessively for services performed, or rent that is unreasonable, or perhaps even unreasonable levels of debt, or interest rates well in excess of market. When these occur, the IRS will recharacterize the payments as a non-deductible dividend, which is otherwise known as a constructive dividend. On an interesting aside, note that excessive wages to shareholders is the problem with a C Corp, and underpayment of wages is the issue with an S Corp. As an example of a constructive dividend, let's consider Elon. So Elon has a small corporation with no significant cash, but loans it $1 billion. Given the inability of the small corporation to repay Elon, it is likely that the debt will be recharacterized as equity due to what is known as thin capitalization. As a result, the interest will be treated instead as a constructive dividend. The term tax shelter has a checkered past in the tax world. In general, the idea is to generate income, but shelter it from tax recognition. One simple way to do this, as we have seen, think Jim and Pam, is to leave the earnings inside the corporation, and then never distribute those earnings as a dividend, or at least not for a very, very long time. When individual rates were as high as 39.6, but corporate rates were 34 or 35%, the small rate arbitrage was not really worth the retention of earnings at the corporate level. However, now corporate earnings are taxed at 21%, and the highest individual rate is 37%. Leaving earnings inside the corporation could again become a popular tax planning strategy. However, the IRS has two provisions that it will need to dust off in the fight against this type of tax shelter: the accumulated earnings tax and the personal holding company tax. The details of both of these taxes is beyond the scope of this course, but suffice to say, they are designed to prevent the buildup of earnings inside the corporate form, and likely are going to force dividends on a closely held corporation. Great, we finished Chapter 12 in our stroll through Entity Land. It's right next to Fantasyland at Disney. Be sure not to miss Mr. Trump's Wild Ride. Thanks for watching.